At the time of this recording, the Fed has recently restated its determination to bring inflation back down to earth. Sorry. And with the markets responding negatively, it's safe to assume that we can prepare for a recession in the near future. And if you don't know who I am, my name is Robert Roy, and I am the founder of WealthBuildersHQ.com, where we teach traders technical strategies to build their wealth utilizing the financial markets. Now, in a previous video, we talked about how to profit in the market downturn. In this video, we're going to talk a bit more specifics of breaking down what's been happening in the markets, talk about some key levels we're watching, and I'll even reveal a few symbols that I'll be watching as the market dips. So let's go ahead and dive in. So let's go ahead and jump in and start off first. Where else? The S&P 500. Let's look at some critical levels and the violations that have taken place. So when we jump over on the chart, I'm going to grab a drawing tool. And you can see down at the very bottom here, we had a nice V bottom, good strong move up, little hiccup in the middle. We had this dreaded box of neutrality here, great move up, and then this fail. And we closed on this day right down bottom of the candle, and we gapped down the very next day. The open came near this dark black line. That dark black line is a serious, critical Fibonacci level. It's the 4181. If you're not familiar with that, jot that down. That 4181 on any chart, it could be on Amazon if they were at that price. It doesn't matter. Any chart is a critical level, but none more critical than on an index like the S&P 500. Now, it's not going to matter on the Dow. You're not going to get down to 4,000, I don't think, anyway, in the near future. How about that? That 4181 critical level, it is a major Fibonacci level. You may not realize it. You may not see it. You may not even think about it. But the stock moved in there, and look where it played around. Right over here, it kept bumping its head, bumping its head, bumping its head. And this is not the only place, right? Remember, we've got more history on the chart, right? If we go back in time, look at right here. 4181 was a major, major turning point for the market. We started to move up. We tried, and we failed, right? We've pulled back down. We look at what's going on. There's not only a 4181 level there, but there's also a Fibonacci, which is a 4183, I think it is, in there. 41, let me see. Let's open it up. Let's get the exact number there, because I'm not able to see it because the black line is over it. So we're looking at the 236. Come on, Rob. 4182.80. Write that down. If you don't have the fibs drawn already, that's the level. 4182.80. So look at that. 4181 and 4183, let's call it. They are right on top of each other. Talk about a major confluence with two critically important levels. The 4181 and the 236, which represents one word, hesitation. It's a hesitation point. Okay? Well, not only that, we broke through. We came back, popped our head above, even broke above the 8 moving average. And that was nothing more than popping the head above the top of the trees. You climb the tallest tree in the forest. You pop your head above and go, wow, what a view. All right, that's it. I saw it. Let's go back down. And that's what happened. The next day, we opened up about flat. We had a major fail off of that. We got a moving average cross. We got down below our lowest moving average. We went from a true bullish bias down to a bearish, not true bear, but bearish bias. And then from there, we just continued to move down. And here we are today, intraday chart, where traders are trying to see if that 3,900 level is going to hold. Every one of these 100-point levels, every Fibonacci line is a major support and or resistance level that the market will have to contend with. We push back to the upside again. What does it take for me to say we're in a bullish bias? If you go back and watch any of the trainings that I did right before we broke out up here, we had this breakout and we failed, right? And I said, and I quote, I want to break out and a close above that 4,200 level right here, close above, fall back below 4,200, stay above the 4181 level, at least on a closing basis, and bounce. Get back above the 4,200. So what does it look like from a technical standpoint? I want to see this move here. We made the breakout. I wanted to come back, and I just drew up that high just so you could see the line because of the black candle here. I don't want to get in the way. Come back down in between these two lines somewhere, bounce, get back up above the 4,200, and now I'm ready for bullish entries. That never happened. Why? Because people took the breakout and had their heads handed to them on that trade. I say it again and again, I'm not a breakout trader. Doesn't mean it doesn't work. I know plenty of people that trade it and are good at it. I'm not. It's not what I do well. All right? So when it comes to the fibs and S&P, along with those key levels, make sure you focus on those. Recently, the Fed, Chairman Powell, was down in Jackson Hole at that major meeting where he talked about, brought up that he does not see any backing off. He doesn't see things getting better anytime soon, and he is committed to doing whatever it takes to get inflation back on track. The funny thing is, it's another politician doing something way too late. This should have been done well before, and I understand there are some things that are not in his purview that he cannot do until X happens, because some analyst somewhere had decided at one point that we need 3/4 of this data before we're able to call it a recession and this and that and blah, 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 blah. Right? But if you go back and look at history, we've allowed this to happen 2000, 2008, the same thing happens. And then we ramp up with massive increases in the interest rates, and then we get this massive crush taking place. As we're trying to fix the economy, we blow the market up. Right? Go back and look at 2000 and 2008. Look at where Keynesian economics kicked in and some of those types of things. Right? It is a major critical area that we're dealing with of news right now, that whatever comes out of the Fed's mouth has the opportunity to dramatically mess with what goes on in the market. So I want to go back and touch on key levels a little bit more. We talked S&P 500, more bigger picture. Let's go ahead and get a little more granular on it. Right? There's a level that is very important right now that traders know where it is, okay? And it is this 20% pullback from the highs that we had. So that level is 38.55-ish. I don't have an exact to the penny. It's close enough. 38.55. That 20% puts us back into bear market territory. Now, as of this recording, we've had 3 weeks in a row, potentially. Here we are on a Thursday, and it's looking like another bearish week for the markets. This is 3 weeks in a row for bearish closes on the market, okay? Bearish moves on the overall market. But that 20% level is going to be critical. Where the location of the moving averages are is going to be critical in relation to the stock. Notice what's happened. The pink moving average, the 8, is now the lowest moving average on this chart. Right? The green is up a little bit higher. Once it crosses the red and the green is below, so in other words, we've got the red or brown on top, the green in the middle, the pink on the bottom. So that is the 55 is on top, the 21 is in the middle, the 8 is on the bottom. Once that happens, all the moving averages are in the right order. Meaning we are now in a true bearish bias. We're bear. We're in a bearish bias now, but true bear represents all of those things lining up properly. All the stars are aligned, right? Well, that's what we're looking for here. Break that correction level, have those moving averages in the right order, break it, come back and retest it and fail, and there you go. It's exactly what we're looking for. That's where you start loading up for bear, right? Whether it's shotgun or whatever you want to do, I'll be loading up on bearish positions, bearish trade setups when I see that happening. When we look at the VIX, the volatility index, it's made up of 8 symbols on the S&P 500 that it measures the volatility of the options there and recalculates that into a chart of what's going on. You know, once we get back above that 30, 35 level, we start to get back into a higher VIX that is not more of the norm. We get there, but we don't get there very often. Like we've been to 80. We never hit 90, but we've hit 80 something twice, right? So above 30 up to 50 is we're an aggressive range. Higher than that is still aggressive. It's just not very common to see it get up that high. So keep your eye on the VIX. As the VIX goes up, that means the markets are going down, which means the cost of options are going up. Put options are going up a lot. Call options are following suit as well. They're getting higher, usually not as high as the put options go, but they're still costing more money than they should. When it comes to what stocks I'll be looking at in a recession, it's not as easy to say if we're going to look to trade Microsoft or Amazon or whomever. okay? Because I think every company can be affected, and management of those companies and some of the financial situations they're in now can play a role in that. I mean, heck, there was a company today that's being sued by the government because their CEO, they claim, the government claims, lied about where his residence was, and he has $25 million that he didn't pay in taxes. And they're suing the company for aiding him in that, right? Could that have a dramatic effect? Well, they're going after the individual, the CEO, for $100 million on the 25 that he owes. Guess what they're going to do with the company, right? This could be a long, drawn-out scenario. It could be very costly to the company and so forth. Would that affect them? Yes, very much so. What I'll be looking for is this. I'm going to be looking for companies with strong fundamentals. I'm going to be looking for companies that have major volume traded on them. And I'm going to be looking for technical patterns in industries that are growing. So I'll give an example of what might not be growing. We're already seeing oil prices drop further than they expected. Why? It's not because the president went ahead and released strategic oil in the U.S., not that much that they've dropped as much as they have, right? A lot of it's coming down to we have more inventory than we did before. And that's because we're seeing less usage and fear of the usage dropping if we hit recession, because now we have layoffs, which means less truck drivers, less people buying stuff, less people spending money, and just driving, period, right? So I'm not looking for a particular stock. Outside of, I will be looking to trade the spiders, and I will be looking to trade the Qs. Those are my two go-tos over and over and over again. Up, down, sideways, it doesn't matter. You can make money as an options trader regardless of what the market does. Not to sound like that guy, but there's tons of money to be made to the downside. Millionaires and billionaires will be made out of a recession. And I get it. Some of you might feel bad about making money while markets are tanking. If you do, then go ahead and do this. Make the money and give it away to a charity or somebody that can use that money. And if that still doesn't make you feel better, I'll be happy to take those profits off your hands, and I will give them to someone that I know can use it. Until next time, make it a profitable day. Stay focused on the quest to becoming a great trader. Keep crushing it, and remember, you're just one trade away. Stick around and check out another great training right here.